All right, then, ladies and gentlemen, on to the top story this hour. My question is, did India grow at 7% or more in FY22 to 23? Well, the RBI Governor has an answer, and he believes that, in fact, it did. Shaktikanta, the RBI Governor, sees improvement in private capex, but also maintains that the fight against inflation is not over yet. His statements give us an insight into the state of the economy. Let's listen in to some of the things that he said today at CII's AGM in the national capital.
In fact, all the fast move, high frequency indicators, about 70 of them which we monitor in the Reserve Bank of India, almost in all of these high frequency indicators, the momentum was maintained in Q4. So therefore, I will not be surprised, we should not be surprised if the growth is slightly more than 7%. For 23-24, we have given a figure of 6.5% capex, and the infra spending by the government has also picked up with, again, large provisions in the budget for capital expenditure by the government. There is evidence of revival of private investment also. We notice it in certain sectors, particularly steel and cement. Your members of CII will know better. Capacity utilization in the manufacturing sector, according to RBI's latest survey, which we have published, is around 75%. But I am told that the CII's survey shows that capacity utilization in manufacturing sector is even higher. There is this forecast of a El Nino, and we have to see whether it actually happens or how, if it happens, how intense it is. I would just like to say that the war on inflation is not over. We have to remain alert. There is no cause for complacency. Especially, we'll have to see how the El Nino factor, what has been anticipated, the El Nino, how it plays out. So far as the Reserve Bank is concerned, our approach and our endeavor has always been to be prudent, proactive, and act in time. We were prudent then when we decided to increase the rates by in a surprise meeting, and we are also prudent now when we have decided to take a pause. So it's a case of prudent then and prudent now. That's our assessment. I mean, somebody can disagree with that, but it gives us a lot of satisfaction that the markets, the industry, the business, and even the analysts have endorsed the decision of the Reserve Bank of India.
You're a cricket fan, so I'm tempted to frame my next question around that. So can I say that Reserve Bank of India, in cricket terminology, is no longer fighting with inflation on the front foot? You've come on the back foot?
No. We always like to, choose the shot. We always like to our approach is to choose the shot depending on the, depending on each ball. I mean, in cricket, sometimes you have to play front foot, sometimes you have to play back foot. But by and large, in the last 2.5, 3 years, ever since the pandemic began, we have been playing in the front foot, and I think even at the current moment, we will play in the front foot, but when it is necessary, we will step back and leave out 1 or 2 balls and maybe go for a slight, a late cut. We undertook many liquidity infusion measures. We saw a clear evidence of companies, big and small, deleveraging themselves, using the liquidity available in the market, using the benign liquidity conditions. Corporates deleveraged themselves and repaid their high cost, reduced their high cost borrowings. So as a result, when the pandemic ended, I think most of the corporates, or should I say many of the corporates, had balance sheets which were quite, which were deleveraged compared to where they started before the pandemic.
So the RBI Governor there, in conversation with ET Now's managing editor Nikunj Dalmia last year, he stated that RBI has been really prudent as far as the policy is concerned, as far as the monetary policy is concerned, and he said that we are open to playing on the front foot, but we're okay with stepping back as well. Well, to discuss this further and to discuss if India really is on track to become the third largest economy in the world, we're now joined by Mitali Nikore, founder and economist, Nikore Associates. Siddharth Sanyal, who's the chief economist, Bandhan Bank. Now, thank you very much, Siddharth, and of course, Mitali here for joining us on ET Now. The governor sounding really bullish on the Indian economy, saying that the FY22 to 23 growth could top 7%. So where is this optimism really stemming from, considering that the IMF had given some really different numbers? So what's really changed between April when the IMF came out and now? In fact, the RBI had also stated earlier that the economy would grow at 6.5% projected for FY24.
So would you like me to start?
Yes, Mitali, go ahead.
Thanks. So thanks a lot for having me on the show. And I think, today the main point to highlight is, of course, there is a note of optimism. India is a global bright spot. When we look at the overall economic growth trends, when we look at emerging markets, developing countries, and even developed economies, India is outstripping the growth rates of most of these economies. The post-COVID recovery in India has also been very robust, and it has in fact been much faster than most emerging economies. But on the other hand, I think today the main takeaway for us is that this is probably one of the first times that a governor of a major, emerging economy, the monetary, the RBI governor for the first time has really said something about the impact of climate change on economic growth and on economic development. And he has made such a clear linkage between the El Nino effect and on, economic growth, because this is one of the first times, and now there's an increasing consciousness and realization that as you have more and more, climatic events coming up, these are going to have an economic cost. There is going to be a direct cost of the disaster at any rate. Any sort of climate disasters that come up because of the El Nino effect, but also in terms of opportunity costs that, if we are not investing in climate resilient infrastructure and climate change prevention and mitigation services. So I think this is the one thing to be noted, that while we are doing very well as a global bright spot, there is that looming threat of climate change, and climate adaptation, resilience, and mitigation efforts have to be scaled up in order to mitigate that risk.
Right, Mitali, you point out a very interesting point that he actually mentioned. He mentioned a whole host of factors, including saying that there are several upsides to India's domestic growth, and which is why leaders and corporates, CEOs across the world are really bullish on the Indian economy, seeing India as the bright spot. So RBI Governor once again to reiterate, saying that, agriculture is doing well for us, domestic demand is doing well for us, capex and infra spending has picked up. In fact, key economic indicators are also pointing towards the economy doing rather well. Credit uptake is also good. Revival of private investment is also good. Siddharth, I also want to first take your initial thoughts on this, and then we'll proceed ahead with the discussion.
Well, I think this is a very important discussion at this moment. And the way I see it, rather than trying to focus too much on one particular projection and one particular number for the year, I think during this particular year, which has a lot of moving elements, we need to focus what are the major drivers of growth and how exactly they are stacking up in a year like this. So major drivers of growth in case of India are private consumption, overall private capex, government spending, and net exports. Of which, on the private consumption part, what we have seen in terms of the RBI's own consumer confidence surveys and all, we have seen there had been a very significant uptick in consumer confidence. It's almost back to the pre-COVID level at this moment. Going ahead, we need to figure out, as inflationary pressures have come down a bit, disposable income in the hands of consumers are higher, how exactly it moves higher, or how fast it moves higher going ahead. So I think that's the biggest and most significant part, because this is almost 2/3 of the overall GDP contribution. GDP contribution comes from this particular factor. The other part is private capex, which we have seen getting the support from governments, infra projects and all. And at this moment, that seem to be doing reasonably well at this moment. We all know that the net exports part or exports part cannot do, or I should put it this way, given the global situation, exports may not do that well in this particular year. But as I mentioned, that when we talk about net exports, net of our imports, given that the commodity prices are coming, witnessing some cool off, net exports numbers may be decent. And the fourth part is the government spending, which in an election year remains relatively fine. So I think the three smaller numbers very clearly remain favorable. We need to see how exactly private consumption demand stack up over the course of the next 3 to 6 months. But whatever may be the outcome, and irrespective of whether the growth numbers eventually are closer to 6% or closer to 7%, in the current global situation, this number will come as a very, very positive number against the current global macro backdrop.
Right, so this number will come as really, really encouraging and will perhaps put India on the global map as far as growth is concerned, because all the other markets, the Western markets, are slowing. So obviously India stands out as far as the overall global economy is concerned. But Siddharth, Mitali pointed out a very, very interesting factor when she mentioned El Nino, and you just said that private capex is also picking up. But do you actually expect demand to pick up this year? Is there a definitive answer to that, or we'll again have to be in a wait and watch mode?
Certain factors are quite favorable, as we were saying that till about 6 months back or even 3 months back, inflation was a much bigger concern. It looks like the concern of inflation, as the governor rightly says, the fight against inflation is not over, but it looks like that it's in a slightly more favorable situation. So the upward pressure on interest rates is relatively less at this moment. A few months back, the pressure on currency and overall BOP and current account deficit looks a lot more significant. At this moment, Indian currency is actually doing very well. There are spells where you might actually witness the currency appreciating a bit. That also cannot be ruled out. So some of these factors, some of these worries, which had been troubling us over the past 3 to 6 months, seem to be in a lot better footing at this moment. The worry about weather-related disruption is a real one, no doubt about that. The frequency at which we see now somewhat significant weather-related disruption, both in India as well as globally, I think that's very significant. And I think here, the word India and globally both are very, very important, because food grains and some of the other agricultural commodities markets are very, very interlinked and global in many cases. So even if something happens in some of the other, a few thousand kilometers away, but that can actually put some bit of a pressure. So these things, we don't have too much of a clarity at this moment, but otherwise, whatever we call as core macro fundamental factor, they seem to be on a significantly better footing today compared to what we had been seeing in the beginning of the calendar year, or maybe a few months earlier.
Right, Siddharth. So, of course, there can be no definitive answer as far as demand is concerned and whether a demand momentum can be maintained. Mitali, coming to you on the very, very obvious question of rate hikes, he said that it's a pause, not really a pivot, meaning that maybe in the near time, the RBI could look at pause, but, in the longer term, there could be actually an interest rate hike as well. So, even as CPI has come down to less than 5%, but will it be wrong to ask that the RBI has to tune its rate hikes with what the Fed really does? And what's your overall assessment on the rate hikes in the next MPC meeting by RBI? Where is it going to go? And what stance is RBI going to take?
So I just want to react on one thing before I comment on the rate hikes. And I think, my co-panelists talked about macroeconomic fundamentals. And, when we talk about macroeconomic fundamentals, we always look at some key rates. Of course, the monetary rates are part of that and growth rates are part of that. But I do think that now the time has come for us to start looking at and expanding our definition of fundamentals. And the risks that are posed by climate change have to be looked at as part of the key portfolio of rates that we see, quantifying the impact on the growth rate and quantifying the impact on economic growth, inclusive economic growth, has to also now be part of our, macroeconomic fundamentals. I just wanted to make that point. Now, on the macro rate hikes and the monetary rate hikes that you talked about, I think it really, really now will depend on where inflation goes from here. Because if we see that now it is stabilizing, then there will be an interest in RBI also to keep most of the rates stable, for the next 2 quarters at least, before starting, kickstarting, maybe reducing rates even to kickstart some amount of, growth activity. But I think it is very important at this stage to have more stability and predictability in the system, particularly with other changes that are going on the monetary landscape, like the, withdrawal of the 2,000 rupee note, etc. So it's important to have as much stability in the system as possible. And a little bit of this will also be determined by the interplay of food inflation and how that comes into retail inflation, and then of course the global oil prices, because then they play a role on fuel price inflation. So all of these factors together will determine, but I do think that at this stage the thinking is to have them on hold and as stable as possible, so that we can have more predictability in the system.
So you are actually voting for a pause and, maintaining the status quo. But then now, Mitali, there are certain uncertainties, especially in the near term, like the fate of the debt ceiling in the United States, which still hangs in balance. So what does the path look ahead? I'll take this question to you, Siddharth. Have rates indeed peaked? So I have two questions in one, if you could answer.
I think that's a very valid question, and to some extent, Mitali actually explained some of the part very nicely. I think the way I see it, if you see the RBI and the MPC, they have actually been very decisive in a lot of steps that they have delivered, and they were not hesitant to deliver things in at times surprising the market, at times front loading some of the moves, rather than keeping it backloaded or relatively less emphatic. So at this moment, it looks like RBI has an inflation projection path, and that moves for next few quarters, moves mostly in the vicinity of low 5%, 5.1 to 5.4, if I recall correctly, in most of these quarters going ahead over the next 3 to 4 quarters. Now, if broadly we see inflation moving in that zone, I think the immediate pressure on RBI to hike further at this moment will be really, really less. So in other words, if inflation moves in that zone, I expect RBI to remain on a significantly long period of pause on the rate side. A very interesting factor will be to figure out how exactly they guide us in the upcoming policy on possibly on the liquidity side. Of late, with what we have seen, that RBI had kept on providing liquidity as and when the market needed it, but we need to figure out that how exactly RBI guides us in terms of the overall liquidity picture, and how exactly RBI will be supporting the liquidity needs of a growing economy.
Right. I think, Siddharth, I think just 2 days back, the RBI governor, while addressing the entire issue of phasing out of the 2,000 rupee note, stated that there is enough liquidity in the system. So what's your final take? What's your final word on where the rates will go this time round?
Well, in terms of the policy rate, we do expect the RBI to stay on pause in June, and unless there is any major surprise on either on the growth or inflation front, my expectation is that it's not only in the month of June, maybe a few more policies and MPC meetings in subsequent rounds also, you might actually see the rates moving sideways at this moment. Now, what does it mean for some of the other market-driven rates? So, for example, 10-year bond yield, which is a very, very important benchmark rate. I think that will be guided by near-term supply demand, but apart from that, frictionalities and tax outgoes, etc., but apart from that, directionally, if and when market gets some kind of a certainty that RBI is possibly done with its rate hike, there might be a softening bias in that particular rate in the next few months. But having said that, I want to emphasize this particular factor. I don't expect the RBI to really start cutting anytime soon. Most probably they will be staying on hold for a significant significantly long period of time. And depending on inflation data, they will have a close vigil on that. And they will not rule out the possibility, and they're absolutely right in saying that they will not rule out the possibility of even a hike at some point of time if there is a need. But most probably, if the inflation forecasts are met, that might not be needed.
All right, Siddharth, thank you very much for joining us. Mitali, thank you very much for joining us. As both our guests said that it might be a pause, at least in the near term. In fact, Siddharth also saying that for the next couple of months, the RBI, in fact, might go for a rate hike pause. As far as the repo rate is concerned. But for now, we'll have to leave this conversation here. Moving on to another story from the RBI. Well, RBI is to give sufficient time to banks for transiting to expected credit loss ECL norms, and the implementation is unlikely soon. ET now has learned from sources that the regulator has agreed to banks' request for giving more time for implementing these ECL provisioning norms. My colleague Ankur Mishra is here with all the details as far as the story is concerned. Ankur, over to you.
Yes, reliable sources have informed us that Reserve Bank of India is not going to implement expected credit loss provisioning norms very soon. What we have learned is that banks had requested Reserve Bank of India for delay in implementation by at least 1 year. So, Reserve Bank of India has definitely given assurance to banks this will not be implemented in a hurry. Sufficient times will be given to banks for preparation. As far as the expectation is concerned, what we have understood is that banks are expecting this implementation not before financial year 2025. So, one of the worries which market had that after ECL provisioning norms needs to be followed, although it has to be split in 5 years, it will impact the balance sheet. But now since sources are informing us that it is not happening in hurry, there will be a meeting which is going to be held with banks before finalization of norms. And also we try to understand how much of the impact actually it can have. The banks which has done some internal calculations have informed us that the impact will not be more than 2 to 2.5% of CRAR if you consider the current numbers. However, as far as the finalization of norms are concerned, after these norms are finalized, only then banks will be able to assess the exact situation.